Well, let's welcome on board Nilesh Shah, MD at Kotak AMC, and find out what he's making of the current market construct. Nilesh, hi, good morning, although it's not really turning out to be the best of mornings. But Nilesh, I'm really wondering why the panic in US equity markets. I understand why India may be falling because it was an out-of-turn policy. Suddenly you heard the governor being extremely worried about inflation. But why US, considering the Fed actually played on expected lines? The markets actually jumped up the day of the Fed decision. Then why this fall?
Well, markets are always wiser. In US, inflation is higher than India. They are, now just about to reverse their fiscal and monetary stimulus. We reversed that long back. So clearly today there are multiple factors which are pulling investors in different direction. The first is Russia-Ukraine situation, whether it is stalemate, whether it will result into higher escalation, one doesn't know. The second thing is the bond drought, which is happening globally. Inflation has remained high globally and significantly higher than emerging markets in developed world. Emerging market banks started taking action much earlier. Developed bankers were pretty late. Their fiscal stimulus was high, and many loss-making companies whose capital model was to burn capital, they were getting very high valuation. So confluence of lot of events have happened. If I have to use just one line, easy money and ample money, both are going away. And in a falling tide, we are all now trying to realize which one is not the fundamental boat.
I would just add another phrase to that. Everyone seems to be selling in May and going away. But Nilesh, what happens from here? I mean, do you begin to challenge whether the bull market is intact or not? I mean, in terms of a net basis, it's not like we've not seen days like these. We've seen worse in 2020 when COVID struck, or even many a times before that as well. But purely because inflation, macros, and all the parameters that you just highlighted, would they make you worry about the longevity of this bull run?
So in every bear market, Ayesha, seeds of bull markets are sown. Today, if I look at companies, and I can quote American companies, right from Apple, Google, Microsoft, Netflix, Facebook, they are available between 15 to 30 times 1 year forward PE. They all have corrected significantly in terms of valuation. If I look at even a new age company like Tesla, they have corrected and their earnings have picked up. So clearly there will be one set of companies which are doing well, where valuations are reasonable. And in that portfolio, bull market will begin over a period of time once some of this uncertainty is behind us. On the other hand, there are companies, and I quote from a tweet which I got on WhatsApp. One mentioned that the stock has fallen 94%, so it's a great buy. There is possibility that stock can bounce back. Your downside is only 6%. And then someone corrected saying that, Bhaiya, 6% is not the downside. You can still lose 94% from here. And despite giving this message, the other person replies back, so are you saying that I will have to pay the price for someone to buy my shares? How can a stock go down, 188%? Now, this kind of illogic, irrationality is also present in the market despite this correction. And in that kind of portfolio, with that kind of investors, I think bear market has just begun. There is still more downside over there. So this will be the market of stock pickers. If you are smart, if you are rational, you will be able to build portfolio of good companies available at decent valuations and make money.
I'm so tempted to ask you which is this stock that they were talking about. We'll leave that for some other day. Okay, so Nilesh, I get your point. You're saying that the market is divided. It clearly is. And I guess the exuberance is also coming from, look at the kind of recovery you had from 2020, right? You could have bought anything and that made money. But what happens now? Because what one has seen of late is neither growth nor value has been spared. Having said that, growth clearly is getting challenged and value has been some sort of, somewhat resilient as opposed to the growth story. Do you go by this prognosis at all, where you bet on value now and not as much growth?
So, Aisha, I humbly submit myself to the market. Today, this is not the market where one can take a definitive call because events will shape the direction of the market. If we look at employment data in US, if we look at inflation in US Fed rate should go higher than what is discounted by the market. But if I look at the first quarter GDP number, which showed minus 1.4% GDP growth, few more quarters of negative growth, and will Fed have ability to raise interest rates despite employment and inflation? Who knows? On the oil, one can say oil prices can go higher from current level if there is further escalation in Russia-Ukraine situation, or oil prices can crash big time if Iranian and Venezuelan oil starts flooding the market. The same thing is possible in Indian scenario. Our inflation could go higher, or with the oil scenario globally and good monsoon, it can top off significantly. Now, in this kind of scenario where it is not possible to take how future will shape up, it is most important to submit to the market and wait for events to play out. Obviously, when it is raining, you still need to cover yourself with an umbrella or a raincoat. What is umbrella or raincoat available in this storm? Good quality companies, companies where businesses are real, companies where valuations are reasonable. Stay with these companies. You will get hit undoubtedly, but it will be far lower and bearable. And eventually, when the storm will end, when there will be some clarity, you will still be able to capture the upside.
So build this fantastical portfolio for our viewers, Nilesh, and I'm only talking sectors here because what one needs right now is a macro shock portfolio. One thought that IT could be that one hiding place, but clearly not. Even IT has fallen because of, the frothy valuations that some of these FANG stocks were quoting at, and that's rubbed off on our Indian IT stocks as well. So where is it that you find comfort in this market, and where is it that you would tactically place higher bets perhaps?
So, Aisha, it is far more bottom-up market than top-down. You want to be with companies where management is good and businesses are real. Today, unfortunately, in market, there are many businesses, which are not real and still are getting much higher valuation. The second point will be the valuation. Today, there are many good businesses which are available at expensive valuation, so one will have to be careful. But keeping those two things in mind, good businesses run by good managers and available at reasonable valuation, one can build portfolio in large cap IT, pharma, industrials and capital goods, and top end private banks. I believe this portfolio should protect you on the downside. It will fall, it will give negative return, but probably much lesser than the market, and definitely far lower than that portfolio where valuations are unreasonable. Over a period of time, this portfolio will also outperform the market on the upside.
Pull out, Nilesh, one of those sectors that you flagged off, capital goods. And just owing to the fact that incidentally we had ABB's numbers come out yesterday, and what a positive surprise it was. Just going by that and the kind of, commentary that you're penciling in for capital goods, the fact that now a lot of those pandemic-induced worries are now behind us. What is it that you're penciling in when it comes to capital goods? And even within this space, are you just cherry picking and sticking to the large cap names? Or is it sort of a blanket or a call across capital goods?
So on the capital goods industrial side, our bullishness stems from a couple of reasons. One, locally government spending will be higher on capex like last couple of years. So that growth will continue to support industrials and capital goods in areas like road construction, water, and so on and so forth. Second, there are certain private sector industries where capital expenditure cycle has begun. Steel, sugar, renewable energy. These are the places where we believe capital expenditure cycle has begun. Even areas like coal, thanks to the current situation, we believe capital expenditure cycle will begin. So government spending will get complemented by some sort of capital spending by private sector. And the third opportunity is on the export side. Globally, many governments have rolled out fiscal stimuluses. Like our government, they are also spending on creating infrastructure. Companies who are catering to exports market or who have parents who are present in exports market and can outsource some order over here. These three combinations of local government spending, global outsourcing, and private capex rising put together will support industrial revival. Obviously, this will be choppy movement. It won't be a straight line kind of movement. But if you build portfolio of industrial companies at intermediate level, I think over a period of time, that should be an outperformer. Some of the results, as you mentioned, have been encouraging and testifying that our hypothesis is in right direction.
So there's a number of factors there when it comes to the capital goods sector. But just talking about, the way forward for a retail investor at a time like this when there's the choppiness in the market, what are you advising by way of portfolio allocation in terms of debt, equity, and what do you believe the retail investor should ideally do at a time like this?
So let's say there are three kinds of retail investors. One who is over-invested into equity, looking at performance. LIC is a brand which connects with every Indian. Now, they have become a listed company. It's a journey from being an unlisted company to listed company and become a torchbearer of the Indian capital market. It puts enormous responsibility on their shoulder, and I'm sure they will be able to discharge it to the fullest extent possible.
Nilesh, in that same go, while it's important to know what to invest in, it's also important to know what not to touch in this current market environment. So you've given us your buy list. What's the avoid list now?
So clearly, we are avoiding all those companies where we believe valuations are unreasonable. There are stocks where floating stock is limited or there is concentrated holding, and hence valuations are way above what one will deem reasonable. In an era where ample money and easy money or cheap money is going away, all these citadels can come crashing down once market supply emerges. So we are trying to be with companies where valuations are reasonable and avoiding companies where valuations are excessive.
It's been a pleasure having you on board. Thanks so much for joining in, Nilesh. And bearish as you may sound, you're advising a lot of caution and advising that as of now, stay with some of the safer bets and well-managed companies.
So I will call myself realist rather than bearish.
Okay, we'll call it that then. Thanks very much, Nilesh. Great to have you on board. What's happening with